Welcome back. We've had quite a slew of economic numbers over the past week or so. I wanted to take a quick moment to recap what we've seen. The green numbers over here, the numbers indicated by green, are numbers that beat estimates, and those in red missed estimates. The biggest news last week was the producer price index that fell short of forecast of 0.4% with an actual 0.2%. And that did follow the prior CPI number, which was also less than expected. Empire State Manufacturing, retail sales, import price index, building permits and housing starts, and existing home sales all beat expectations. But I think the vast majority of the numbers were negative, including industrial production, capacity utilization, business inventories, the home builders index, the Philly Fed manufacturing index, which was very weak, and the leading economic indicators. What we're going to do is point out what I think are the most significant points. Really quickly, take a look at some of the charts. Here we like to chart the actual releases of the economic numbers to try to give you a visual of what we're looking at. The home price index certainly has turned to the downside, so has the existing sales prices of homes. Now the PCE, the personal consumption expenditure, which is a measure of inflation, that continues to march higher, as well as the CPI. Well, we just said that the CPI and the PCE were less than expected, which is true. However, putting aside the fact that it was less than expected, inflation does continue to rise. It's just rising a little bit slower than analysts have expected. But as home prices continue to weaken, take a look at also existing home sales and housing inventories. That also shows us there's a lot of weakness out there. Let's see here. Durable goods continues to be strong. Take a look at the University of Michigan. It has been weakening over time. But the big disappointment, I would say, also is the Philly manufacturing outlook right near the lows. Also, residential construction quite low as well. Another way to look at this, take a look at the CPI. That's the Consumer Price Index. This shows us for the past 10 months. We have now hit a new high over the past 10 months. So again, we've failed to meet analyst expectations, but on a number-to-number basis, the CPI and the PCE, these inflationary numbers, still continue to make new highs. Existing home sales, new lows. Industrial production, capacity utilization were at new highs, as well as durable goods. And this is over the past 10 months, just to give us an idea of what we're looking at over here. Housing active listings is a new high, but I don't know if this is necessarily a positive thing, because maybe this indicates there's more homes on the market and they're not being sold as quickly. And then, of course, we take a look all the way to the right, the Philly manufacturing outlook, new low. The last number was 4.4. That's the lowest number we've seen this year in 2022. Taking a look at the bond markets, the greatest one-day change in interest rates over our U.S. Treasuries are the short-term bonds, the 1-year, 2-year, 3-year bonds. Those have gone up more than any of the others. Now, when bond yields go up, it means the prices go down. So traders are selling the short-term bonds. This is on a daily basis. Taking a look at the little bit of a longer-term picture, top right-hand side, the blue line represents the S&P 500. We hit this big double bottom in October. We've been moving higher. It hasn't been easy. It's been a choppy market, and it looks like it's weakening again up near the 4,000 S&P 500 level. The red line represents the total bond yields. If you add up the yields of the 30-year, the 20-year, all the way down the road, we see that the yields are starting to weaken to an extent, meaning that traders are buying a little bit more bonds than they were before. When the yields come down, it means the bond prices are going up. But take a look on the left-hand side here. This is the same red line, the total bond yields, right off their highs. But the green line represents the spreads between the different maturities, the spread between the 5 and the 10-year, the 10 and the 20, etc. And what this shows us is the spreads continue to tighten. In fact, take a look at the comparison between the 10-year bond and the 1-year bond, 0.92% inverted yield. The 1-year bond pays a 4.74%. The 10-year bond pays 3.82%. That's almost a full percentage point more for the 1-year bond than the 10-year bond. Now, normally, in a healthy market condition, the longer term bonds pay a higher yield. This is an inverted market, and we've seen a 40 basis point inversion, 50 basis point. All of a sudden, out of nowhere, this inversion has exploded up to 0.92%, nearly a 1% inversion. Now, there is a pretty stark comparison and correlation between the S&P 500 and the short-term bond yields. This is the 3-2 spread, the spread between the 3 and the 2-year bond and the 2 and the 1. We have a 73 and an 86% inverse correlation, meaning as the S&P 500 goes up, these inversions go down. Take a look at it from this point of view. The black line shows us the S&P 500 now settling just under 4,000 for the S&P 500. The blue line and the brown line represent the 3-2 and 2-1 spreads. As the S&P 500 goes up, the spreads narrow. This shows us that while stocks are going up, there still continues to be a lack of confidence, a deterioration in the short-term bonds, meaning a deterioration in the confidence in the near-term outlook. Traders over the long term are not buying these short-term bonds. They're selling the short-term bonds. They're buying the longer-term bonds. They don't have as much confidence in the short-term markets. Now, in particular over here, take a look at the gray histogram bars. This shows us the 30-day percentage change. The biggest movers to the upside of the past 30 days, no surprise, it's energy, kerosene, diesel, heating oil, gasoline to a lesser extent as well. The worst performing markets, well, this is not yet reflected in the 30-day, but we know cryptos have certainly been very weak. But the volatility, the NASDAQ volatility and the VIX index, those have been very weak. That means the stock market goes up. The volatility indexes, which are hedges towards a falling market, those are going down. So the protection is going down while energy is going up. But I think there's a little bit of a disconnect because energy is not the whole market. Take a look at the S&P 500. Now, top left-hand side shows us 500 dots. Each dot represents one stock in the S&P 500. And this is measured on our RSI, Relative Strength Index. So the vast majority of the stocks have an RSI between 45 to 65, maybe almost 70 in some cases. The market's right in the middle of its RSI range, maybe a little bit above middle, maybe it's a little bit stronger. And that reflects immediately what's happened over the past week to 2 weeks. Stocks have bounced hard back to the upside. But take a look at the 52-week range, the bottom left-hand side. Now, this shows us every single stock, same S&P 500 index, but in this case, it shows us each stock in respect to their own 52-week range, meaning that every stock, let's say we have a range of $0 to $100 a share, most of these stocks we would see are trading between 25 to, let's say, 65 on percentage in terms of their 52-week range. So this really does show us a difference. There's a lot more stocks that are trading near their lows, 5 to 25 bracket. Notice in terms of the RSI, there's no stocks, well, there's maybe one trading with an RSI below 25. So the yellow box shows us immediately what's happened. It reflects what's happened over the past couple weeks. What's happened over the past couple weeks? Stocks have bounced back up hard. But this 52-week component shows us that the stock market still is very much scattered, and a lot of indices and a lot of markets are still near their 52-week lows. The market, I think, is damaged. Now, we've bounced in the short term. I don't think this is a full-on recovery. On the right-hand side, it shows us in terms of the histograms bars that count how many components, how many stocks have an RSI with around 60 to 65. That's 124. How many stocks have an RSI between 65 to 70, around 115. So we see most of the stocks, again, are right near the center, maybe a little bit above the center of their RSI ranges. But the 52-week count, the bottom right-hand side, shows us most of the stocks, most of the shares are still trading within the 30 percentile or less, meaning most of the stocks in our 401k plan, in a 52-week range of $0 to $100 a share are probably around $30, $35, $40 a share. There's a lot less stocks that are performing well this year. They've bounced in the immediate past, but they certainly haven't recovered. A lot of damage has been done to the stock market. Now, this looks at the indices, the different indexes that are represented within the S&P 500, and it's very equally spread out across the vast majority. The strongest sectors include the Spider Trust, that's a staples, that's a consumer staples index. We have the Dow Jones Industrial, NASDAQ Telecommunications, Healthcare. Those are broad-based indices. Those are very strong. Or the strongest, I should say. The weakest is a CBO Volatility Index. That's the VIX. That obviously has gone down because stocks have gone up. Other than that, we see the 10-year Treasury Index, the Banking Index, the NASDAQ Composite, Technology. So there certainly are some components of this market that are weaker than others. But in terms of the relative strength, it looks like most stocks have lifted more or less equally. Energy, I think, leading the way. This shows us the divergence, though. In terms of their own respective 52-week ranges, take a look at the strongest sector. That's the Energy Index. Number 2, Oil Index. Number 3, 10-year Treasury Index. Those are the strongest by far. The weakest, let's see over here. Discretionary ETF, a NASDAQ Composite, NASDAQ Technology 100 sector, NASDAQ Computer sector, NASDAQ 100, that's made up of a lot of technology. So in terms of the 52-week ranges, it looks like a lot of technology stocks are near their low, while a lot of energy stocks are near their high. Now, of course, it takes all stocks to make a market, but if we think about the economy is not just energy. In fact, there's many, many people that work in technology and work in other areas of the market. Here's Vanguard Real Estate Index. That's very weak as well. Here's another technology index. So I would say a lot of the very sensitive industries in the market are very weak, like technology. The ones that we know are strong are the energy markets. But when energy goes up, that's not necessarily a good thing for the economy. That might mean that energy has become a lot more expensive for all of us. And finally, take a look at the blue line over here. This is a blue line chart. This is the S&P 500. Has come down since November of last year, beginning basically all of 22. The the S&P 500 has traveled to the downside. It's been a very choppy road down. The red line represents a 30-year mortgage average. That's the average mortgage rate for 30-year loans. The black line represents the discount window. Now, this is the rate that the Federal Reserve, basically lends money to commercial banks. And we can see this has moved lockstep with the mortgage rate, which is certainly to be expected. They're both very interest rate sensitive. I wanted to point this out because sometimes what happens when the economy gets in trouble, you'll see all of a sudden out of nowhere the Federal Reserve will cut the discount window. It hasn't happened yet. We can see back in the early days of 2020, March of 2020, take a look at the Federal Reserve really just chopped the discount window all the way down to 0.25%. We're back up to 4% now. So if we see, and it's not a guarantee it's going to happen, but if we start to see some real economic turmoil, we may see out of nowhere the discount window being cut. And a lot of times they don't even really report it on the media, very much. So it's something that we track here, and certainly we're going to, make note of it if they do cut. They haven't cut, and that's why we haven't really mentioned it. It continues to chug higher along with interest rates. But if it does, if it is cut, if the commercial lending window is cut, then we're certainly going to talk about it here because that could be an early sign of something else to come. We hope this has been helpful. We look forward to seeing you back soon.